Okay, good morning to everyone. Today is the 21st. It's Tuesday, and we're going to finish talking, well, not finish, but get a deeper dive into cash and receivables, chapter 7. And this is all these chapters in Intermediate 1, and really all intermediate accounting are fairly deep. And a lot of times I'm doing supplementary videos just in order to sort of give you a bit more context and whatnot. So, because we just really don't have time, right? Just kind of the way intermediate accounting works. Some schools were taking 3 semesters to do intermediate accounting, and 2 was sort of the norm, and they sort of went to 3 and whatnot. So, bottom line, there's a lot to do. So we're going to talk about this. Now, I do want to sort of point out the due date changes, and you probably have seen those in both Brightspace and Connect. I've sort of moved the due dates for this particular chapter dealing with cash and accounts receivable and notes receivable. The quiz this Friday, and the homework and bonus the next. I'm sorry, Sunday. So 2 days after that. So if we come back to, and we're going to start chapter 8. We're going to get to that on Thursday. I mentioned in my announcement on yesterday that inventories are something I really want to spend a lot of time talking about. It's an important issue. It's one of the more complicated issues, really, in intermediate accounting, and there are a lot of different elements of it. And so we're going to spend some time beginning on Thursday. So what I don't get done today, and I know that there's no way I'm going to get all the way through chapter 7 today. I'll include in supplementary videos. Particularly, hopefully, I can get those done before the due date of the quiz, at least. All these rooms are not always available to us, and so it's not always there. And frankly, a lot of the onus in intermediate accounting is on students. Frankly, I mean, there's just no other way to put it. I know sometimes people bristle at the idea that we're not there to discuss every single topic, but this is really, again, as we mentioned before, the gateway to the profession, and it's something that really needs to be studied. But I will do my best to talk about what's going on and answer any questions you've got regarding any particular topic at all. So that's the plan for today. So I think where we left off last time, I don't know if there was anybody on the Zoom call right now. I don't see anybody there, but if you have questions on the Zoom call, feel free to get with me, or feel free to get with me anytime you have questions regarding anything at all regarding this course. Okay, so I think we left off last time talking about returns, and remember, what we're doing here is we're sort of working our way, through the financial statements, and we're really going to focus here on in throughout the rest of the semester on the balance sheet. And that being said, that sometimes the balance sheet has implications to the income statement, and that's part of the reality of what we call articulation between the statements themselves. But we'll talk about sales returns. And so obviously, sometimes businesses sell things to customers, and the customers are dissatisfied for all kinds of reasons. Maybe they're legitimate, maybe not, who knows. And so customers demand a refund of the entire amount paid, and then return the merchandise itself, or whatever, or the service. If it's a service, it's already done. There's nothing that can be done about it. Or sometimes a credit, and the credit sometimes is often called an allowance. So this is a contra revenue account that's called returns and allowances. And returns are basically where it usually is associated with inventory itself, where it's defective, it is banged up during shipment, it's not what was ordered, it's outdated, it's not what was necessary, what was needed, and so as a result, that sort of creates a full refund. But allowance is where the seller and the buyer agree, okay, I'll knock X% off of the invoice, 10% off, whatever, and keep the goods themselves and sell them. And so we're typically talking, in both these cases, we're really talking more about physical goods as inventory, but it doesn't have to be. And so we have to accrue these at the time that they at the time of sale. Now, here's the thing: it kind of goes back to a lot of the areas that we talked about before, and we've been discussing as we're leading up to this area. Is that we really don't know for a seller of goods what the returns are going to be, what the allowances are going to be, and so as a result, if we don't recognize some sort of allowance for that, that is a credit to, a debit to revenue, which is going to be a sales, it's going to be it's a contra revenue account. And we're really going to overstate the sales as they happen because we know that they're going to happen. Now, discounts are another thing. We talked a bit about that last time. And when we talk about contra revenues, and all contra accounts are simply those accounts which reduce the balance to which they refer when they're usually listed on a financial statement directly below that particular account, the reference account itself. But in this case, what we're saying is that we know that there's some returns come back to us for whatever reason. And so as a result, we have to estimate those. And like all estimations, they're sort of based upon past experience, future expectation, overall conditions. And, it's not always easy. And companies miss high or low on this. They do it all the time. And, it's something that's, I don't want to say it's an art more than a science, but it is a difficult process. I think that's one of the things that I think we should emphasize here is that it's not easy. So sales returns are those things which are coming back on the balance sheet. So what if we recognize returns in the period the return occurs? And so in this case, we sold merchandise for $10,000 in December of 2021. The merchandise cost was $6,000. All right, so the company will recognize $4,000 gross profit in 2021. However, in 2022, all merchandise is returned. So if we do not recognize some sort of allowance in the 2021, the period in which the merchandise was sold, then we're really going to do what? We're going to overstate profit in 2021. And it's going to be a misleading figure because in 2022, sometime all this is coming back. And so as a result, these really weren't sales, were they? Returns are simply a negative sales, where the customer is returning the goods for whatever reason, dissatisfaction, defective goods, whatever the case might be. So we're overstating gross profit, which then falls all the way to the bottom line as an overstatement of net income, actually. And then we're going to understate it in 2022 because we've returned those goods. And so as a result, you get the idea that there are distortions in income that are reflective of the fact that we need to report some sort of allowance. So in this case, a quick example here, we're talking about Hawthorne Manufacturing. During 2021's first year of operations, Hawthorne Manufacturing sold merchandise for $2 million in cash. This merchandise cost them $1.2 million. So in other words, we're going to report, this is assuming a perpetual inventory system, we're going to report the $2 million in revenue, right? Credit balance and cash received. We're also going to reduce inventory by $1.2 million, which is 60% of the cost of the goods itself, or the price of the goods. And we're going to create cost of goods sold in order to balance that transaction. Okay? Industry experience indicates that 10% of all sales will be returned. That's a pretty big number, but let's just kind of go with it. 10% of all sales will be returned, which equals $200,000. That's 2 million times 10% in this case. Customers returned 130,000 sales during 2021. And again, Hawthorne uses a perpetual inventory system, which is pretty much a giveaway because of the fact that we reported the debit to cost of goods sold and the credit to inventory at the time that it happened. So, all right, so in this case, the cost of return to inventory is going to be 78,000 because, so remember, 60% is the ratio of cost to price, right? Remember, cost and price are two different things. We emphasize a lot. The cost is an input value, price is an output value. And so in this case, 78,000 is going to be debited out of inventory, or debited back in inventory, I should say, because we're taking it back in. And we're going to sort of reverse the transaction, partially reverse, and create a credit to cost of goods sold. And then we're going to reverse the sales because 130,000, which was the output value, we're going to debit out. Remember, sales is a credit balance account. We're going to debit that back out, and we're going to refund 130,000 in cash. So all this transaction is partially reversed, okay? Because of the fact that we're simply taking some of the inventory that was sold, it was returned to us for whatever reason, we don't really know, doesn't really matter in this case, but we know that there's something going on, and so as a result, we have to understand what's happening here, okay? All right, so when we talk about accounting for sales return, the selling company doesn't really know how much of 2021 sales will eventually be returned. We just really don't know, which is why this amount is estimated up front with any adjusting entry if that amount needs to be corrected. And this is really interesting because the fact that we estimate things up front, but we're going to be off. And anybody who says that forecasting is a perfect science really probably doesn't know what they're talking about because of the fact that the world is strange and things happen. We just don't really know. We can be pretty good, and a lot of companies are very good at estimating things like returns and warranty claims and all that, but we really don't know. So sometimes we have to make correcting or adjusting entries. And so in this case, at the end of 2021, an additional 70,000 returns are expected. So the cost of the inventory expected return is 42,000. Same company here. Remember, the inventory is 60% of the cost of the sale. So 40% markup, in other words, on over cost. So in this case, we're returning 70,000 goods. So we're going to reverse sales here, right, which is a contra asset sales returns, right, and a refund liability of 70,000. This liability is going to exist until we pay these people off, right, these buyers off, and so and we're going to reduce inventory estimated returns. Cost of goods sold is an expense account that we're going to reverse in the other direction there. So that's essentially what's going on. Is the idea it's an adjusting entry. And remember, we talked a lot about adjusting entries in Principles 1. It's this idea that we need to make corrections mid-course as we go. A lot of times these adjusting entries are made as we approach a financial statement cutoff date, whether it's quarterly or annual, particularly annual. We need to sort of clean things up and make sure that we've got the right figures being reported. And one of the things which I think is disconcerting to a lot of people studying accounting is that I think a lot of people believe that accounting is just simply reporting the facts. All it is bookkeeping and just collecting numbers, collating them, reporting them, plugging them in spreadsheets, reporting them and whatnot. That's not really the case. This is what makes accounting a very lively discipline, is the idea that we have to make estimates. And furthermore, accountants are increasingly called upon by management to say, to report to them what are the estimates that we expect for, well, in this case, bad debts or returns or whatever the case might be. And they're in a unique position to know because they're familiar with the historical trends and what is happening in the overall macroeconomy. And all these things are part of the question. And if we're off, well, we're off. And that's just the way it happens to be. So in this case, any amount that we do the adjusting entry, we need to make a correction for it. Okay? All right, so here's the accounting for sales returns. The 70,000 goods came back in 2022. The cost of return inventory is 42,000. So in this case, the refund liability is reversed. Remember, liabilities are credit balance account. We reverse those because we're now paying those off 70,000, which is what they paid for us. They paid for these goods, right? They didn't pay 42,000. They paid the full price, the markup price, 70,000, the retail price. And so as a result, but we have to sort of back out inventory as well. And we put these goods back in the inventory, which is why there's a debit balance here. It's an asset account, and estimated returns is a credit account that balances that out. Okay, so that's the accounting for sales returns. It's the idea that the goods are going to come back to us, and if you're selling physical inventory, I think you see this happen a lot. I don't know, frankly, that it happens as much in service industries as it does in physical goods. I'm sorry, service industries as it does in physical goods businesses, where there's the issue of spoilage and expiration dates and damage during shipment, and there are difficulties and arguments over who caused the damage and who has the liability for it. Very often the bigger party accepts the liability in many cases just to sort of maintain the sort of goodwill relations downstream, but that's not always the case. So we have to sort of understand what's going on there. So, all right, so let's move on to the next subject here. That has to do with, let me move my cursor here, out of the accounting for sales returns. So we've already talked about that. So let's kind of move on here and talk about correcting estimates. So remember, we talked about this idea that there's going to be an estimate, and what if it turns out to be wrong? And by the way, it's going to be wrong. I mean, one of the things that I know this in my years in the corporate world, we did lots and lots of forecasts, and they were always wrong in some degree, sometimes good, sometimes bad. But usually we would sort of mostly approximate what we thought was going to happen. But within individual line items, we might be really wrong, really wrong. But hopefully at the end of the day, we'd be mostly correct. But it's just sort of the nature of the beast. nobody really knows what the future holds. I mean, if we knew what exactly was going to happen in the future, we'd all be billionaires because we'd be buying the stocks of whatever stock would be applicable during that period. But we don't really know, and so we're trying to adjust to the fact that our estimates are going to be faulty, and they're based upon what we think we know. And this is a science that prediction science is really something that's growing, and where accounting is sort of moving into the financial realm. We're doing a lot more in this regard to try to help us make better estimates of what these expectations are of particularly negative events. Because remember, we do have in the accounting profession a bias toward not exaggerating profits or gains, but rather sort of dialing them down a little bit until we know for sure that they're there. So conservatism principle is really at work here. So we're talking about accounting for sales returns. We're talking about correcting the estimates. So suppose in 2022, which is the next year afterwards, sales are 60,000 instead of 70. Returns are 60,000 instead of 70,000. Well, okay, that's great, right? Which means that we have sales returns that are less than what we thought, right? So as a result, we do the adjusting entry, right? And so as a result, what is going on here? It's $10,000 difference. So the refund liability is less. Now, why do we create a liability? Because we're creating an allowance, right? We have an allowance for bad debt, which is a credit balance, right? And we're going to offset that with a debit balance, right? So we need to reverse that transaction there, and sales returns are going to the other direction. Sales returns are a debit balance, right? Because sales or revenue is a credit balance account. Returns are a contra revenue, which is debit balance account. So we'll reverse that 10,000, and then the cost of goods sold simply reflect the 60% of the actual sales value of those goods, right? So that's what's going on. So adjusting entry, this is good news, right? This is where we thought we were going to have more returns than what we did, and it's a happy surprise. And by the way, the estimation of returns, I mentioned a minute ago, is the idea that it's based upon past experience and future expectations and whatnot. And companies do a pretty good job, I think, of estimating these returns. And sometimes it's a quality issue that needs to be addressed if these goods are defective or whatever the case might be. But for the most part, companies do a pretty good job at that. So, all right, quick quiz question here. Concept check sales returns. $5 store sells merchandise for cash. It began in 2021 with a refund liability of $0. Okay, made sales of $1 million during 2021, which cost them $600,000. So in other words, COGS is 60% and of total revenue, and as 1% of sales will be returned, and experiences $8,000 of return. So, all right, so we got a little bit of a different issue here, right? We expect 1% of the $1 million to come back. Instead, we've got something more than that. So when accruing estimates at the end of the 2021, which is the year in question, FDS would debit sales returns and credit the refund liability for what? Well, it's going to be the 2,000, right? Difference between 6,000 and 8,000, right? So sales returns are going to go up by 2,000, the refund liability going up by 2,000. Now, why is a refund liability? Because we have a liability to buyers because of returning merchandise. So when they return the merchandise, we'll redebit inventory and credit refund liability to wipe that thing out, right? But this is an adjusting entry. Now, these are not particularly large dollar figures, but it does indicate the fact that sometimes the estimates are wrong as to what we expect to be refunding to customers because of dissatisfaction or whatever the case might be. And some companies, frankly, some sellers have more lenient policies as to returns as others. I mean, I think Nordstrom for many, many years would even take in goods from some other place. You buy a pair of shoes from JCPenney and they would take them back for whatever reason. I don't know if those are quite so liberal today, but you get the idea that some companies have extremely liberal return policies, others not so much. And so you might see all sales final signs, right? Don't bring it back, or you're not no satisfaction here, right? And what are you going to do, right? I mean, you bought you bought a sweater, a pair of shoes, right? Can you bring it back? No, you can't bring it back. So, but this is an element of marketing that I think translates over to accounting. And it's the idea that sometimes we accept returns, sometimes we don't accept returns. And you're going to get the idea that it's really part of management philosophy as to what we want to do with regard to returns. But our concern as accountants is what do we do with it, right? So in this case, we have a adjusting or correcting entry in order to make that. Actually, I shouldn't say correcting. That's not even the term. It's adjusting entry to adjust to the fact that our estimates were a bit wrong. So, all right. Next concept check: sales return estimates. $5 sales merchandise for cash. It began in 2021 with a refund liability of 0. Okay, so same scenario. Made sales $1 million. Cost $600,000. So cost of goods sold was 60%. We estimated 1% of sales. So everything is the same. When it creates an estimate of remaining returns, FDS would do what? Debit inventory and estimated returns for how much? Okay, so this is the other part of the transaction here. It's not just the issue of returns on the income statement. It's also this returns of on the balance sheet, what we do here. So in this case, we sell merchandise for cash. The correct is receipts, $1,200, right? And what we're doing is we're simply taking the issue of we're removing inventory we're putting inventory back in the balance sheet. And I think I just talked about this a second ago, and this sort of reiterates what I was really just getting into is the idea it's not just the return and the revenue figure that's going on. In other words, not just the revenue and contra revenue, it's also the asset account, which is affected. We're going to return this back in inventory. And we're going to reverse out of cost of goods sold. Cost of goods sold is an expense account, which typically is a debit balance account, and we're going to sort of reverse that. So what's going on here is the idea. Remember, what we're getting to here in this chapter and all throughout the rest of the course is the idea of what are the balance sheet effects. So we talked a bit about the idea of income statement effects. We have sales, which is a credit balance account, returns, and allowances for that matter, which is a debit balance account. But how does this affect the balance sheet itself? And so as a result, sales returns affect this in this particular regard. So we put inventory back into inventory, assuming that it's saleable. And in this case, we're going to assume it is because we have no information to the opposite. And so therefore, we can return those goods and sell them later to a buyer who may be more satisfied down the road. Okay. And then let's talk about receivables, because this is really the idea. And probably one of the biggest topics here of chapter 7 is the idea of receivables and what they are. Now, when we talk about receivables, we're talking about primarily, and I think in this particular chapter, we're talking about more current assets and current accounts receivable, certainly, but also notes receivable. And we're going to sort of move our way into notes receivable. And again, we're sort of working our way down the balance sheet, left to right. We're going to move our way. We're talking about current assets. We're going to get to long-term assets. And we're going to flip over the right side of the balance sheet in subsequent weeks. And we're going to talk about things like liabilities, current liabilities, long-term liabilities, and then we're going to get into shareholders' equity. But for right now, we are talking about the balance sheet, and we're talking about valuation of accounts receivable. So here's the thing about receivables. Most businesses, particularly in a business-to-business relationship, sell goods on credit. And the credit terms are oftentimes very short-term credit, 30 days, 60 days, whatever. If it goes beyond, I don't know, 60 or maybe 90, you're talking about an obligation that looks more note-like and implies interest. But for the most part, accounts receivable that are exchanged between buyer and seller bear no interest. They're usually very informal transactions. It's usually an invoice. I sell you, I don't know, 500 TV sets, and there's an invoice, pay me in 30 days. Whether it's discounted or not is irrelevant. It's a very short-term obligation. There's really no interest unless there's a discount involved, and a discount usually always involves some sort of implied interest. But it's a very short-term obligation, and companies do that all the time. This is not the same as business to consumer transactions, where if you go to buy a shirt or a backpack for your kid, they're not going to take credit usually. And I'm not talking about layaway. Layaway is a deal where they simply move the inventory out into a back room somewhere, and it's still on their books. It's not on your books at all. They haven't transferred the good whatsoever. There's no sale. I'm talking about the fact that business consumer transactions very often do not involve this, except in the case of services. Healthcare, for sure, things like cable TV, things like a lot of service transactions involve this idea of creating a receivable, but usually it's a business transaction. In the accounting field, we tend to focus on that. So what is it? What does an account receivable entail? So let's talk about the legal issues here. That the seller's entitled to receive payment, and it doesn't necessarily mean the seller will be paid, right? And so as a result, there are going to be losses, right? But the entitlement to receive payment is an enforceable obligation where if the seller does not receive payment from the buyer, the seller can enforce legal remedies against the buyer. And depending upon whether or not the obligation is large enough to justify the legal cost and court costs and all that, is really dependent upon the whole terms of the transaction. But for the most part, the idea is the seller is entitled to receive payment, but they're going to be bad debts, and and I like the term here, the inherent cost of granting credit. So whenever you are a business and you're selling goods or services, for that matter, on credit, you expect to be paid at some time in the future. Whether you're paid or not is sometimes an open question, and not always is the case that people get paid. We know that. There are departments within corporations that accounts receivable that do nothing but collect invoices from customers for whatever's going on. Usually, it's bigger customers selling to smaller customers, or bigger sellers selling to smaller customers, trying to collect those invoices. And for whatever reason, sometimes there are difficulties involved. Certainly, the world that I came from, in the financial world, I was never really involved with collections, but I knew we had collection people who were working the phones and calling people and trying to collect money and whatnot. So bad debts happen. It just is a fact of life. And so the question is, how do we deal with it? In this case, we're going to deal with the example of publicly traded companies, and we got two different methods. One's the direct write-off method, which is decidedly not GAAP. However, the fact that it's not GAAP does not mean it's not used by smaller companies. And this is one of the things that I think we probably should emphasize more in intermediate accounting, particularly here, is the idea of smaller companies are not bound to GAAP principles whatsoever, because they're not publicly traded companies. And so as a result, they can use the direct write-off method. They can use cash basis accounting. They can use all the whatever they want to use. But for GAAP purposes, which is really what college accounting is about, is the direct write-off method is decidedly not GAAP. And so we use instead what's called the allowance method, which is estimated expense recognized in the period of sale. And so it kind of goes to the matching principle where we're trying to match up that expense, the expense being bad debt, right, against the revenue itself in the period in which it happens. Otherwise, you have this distortion, which we've talked about in numerous cases, both in this course and also in Principles 1, where any kind of cash basis system distorts income because of the fact that cash is shifted between periods, and it really results in massive, fluctuations. And it doesn't really reflect what's going on to outside investors. So again, in financial accounting, we are really interested in what's being reflected toward users of financial statements who are external to the company primarily. But having said that, I know this is something we talk again about in accounting, is the idea it's external users, but also internal users, because I can tell you from my experience, corporate executives will look at a lot of these the reported items and decide how they want to discuss these with investors and whatnot. And so as a result, this is not just external investors or external lenders, it's also internal users as well. Okay, so GAAP accounting really does not allow the direct write-off method. But nonetheless, it is important that we should at least talk about what's going on. So the direct write-off method, which again, as your text talks about, is not GAAP. In case you didn't get the idea, it's not GAAP. They're sort of hitting you over the head here. So in this case, we wait until a particular account is deemed uncollectible and write it off at that time. Now, who knows when that's going to happen, right? 120 days, 180 days, 365 days. It's not allowed by GAAP because it is not very rigorous, and it's up to a lot of discretion of management as to when this account is deemed uncollectible for whatever reason, right? But nonetheless, it's required for income tax purposes, and so I'm a tax person, so I realize that there are differences. Remember, GAAP and tax are not the same. And so for tax purposes, it's not really allowed because of the fact that, one of the things the IRS does not want to do is to create advantages for companies that are not commensurate with the actual economic reality. So in this case, we can't just say, hey, this account is uncollectible, and there are 7 days past due, whatever, right? 7 days is not exactly a long past due period. And I know that we talk a lot about this idea of invoice periods. Somebody's due October 15th, somebody pays on October 20th. I mean, it's just not something people are going to freak out about too much. But if you report that as a bad debt, and let's just say it's more toward the end of an accounting period, you report as a bad debt, then what you're doing is you're lowering your tax expense. And so as a result, that's not something that's forbidden here. So what are the two shortcomings? Well, the shortcomings are obviously this, how do we say it, this fluctuation in income, right? So it may overstate the balance of accounts receivable in the periods prior to the runoff. That is the idea that maybe we're going to wait and not write off something. And so we have an asset that's maybe not collectible, but we know it's not collectible, and then we're going to keep it on the books as an asset. So the asset, which is debit balance, also increases shareholders' equity, which is a credit balance. And so we're overstating the balance of the value of the firm because of the fact that we've not recognized this uncollectibility. And that's the balance sheet issue. Then the income statement issue is distorts net income by postponing recognition of any bad debt. So until we recognize it, it's not bad debt, right? So in the direct write-off method, we're saying, okay, it's not uncollectible until we say it's uncollectible. And so as a result, we only record bad debt expense at some point down the road. But it distorts net income, it distorts shareholders' equity because of the fact we could be carrying a lot of bad debt on our books. And that is a real problem. And I can tell you, as a former commercial lender, there are a lot of companies where we would ask for receivables agings, and they would sort of resist and kind of push back and say, we're not quite ready with this yet. And the reason they would is because they knew they had a lot of bad debt on the books, and they didn't want that to show. And this is a problem. This is why accountants are the business truth tellers. We want to get at what's going on. We're the investigators. And if you're sandbagging and saying, hey, we don't have all this bad debt on the books, and you do, that's a problem. And the direct write-off method is got a lot of problems as a result. Now, the solution is not necessarily the allowance method, because you can still make manipulations of that. But I think I've been very clear as we began this course that manipulation can happen all along the line, but we emphasize and we stress the ethical practice of business in the accounting profession. We are bound to report things as we see them, call them as they are, balls and strikes and whatnot. So the direct write-off method is not really used in the GAAP accounting at all because it's simply not allowed. It is used, however, in smaller businesses, and so as a result, that is a feature of it. And I sort of cut my teeth early on trying to deal with smaller businesses that use that particular method, and it was always a tough gig. The allowance method is a GAAP method. Okay, so GAAP requires that the amount of bad debts is estimated, and so what we have is a debit to bad debt expense and a credit to an allowance for uncollectible accounts. It's a contra asset. Okay, so we create usually at the end of the accounting period, where we do an adjusting entry saying, okay, this is what we think going forward is not going to be collected. So as a result, we are going to bring down the value of accounts receivable. So the accounts receivable less allowance for doubtful accounts. In this case, as of 2017, we're going to reduce. We have accounts receivable 13,490, and let me see here. What's going on here with this slide here? Let me blow it up a little bit. In millions, 13 allowance. This one doesn't look like a journal entry. Oh, I thought it was a journal entry. I was thinking, what the heck's going on here? So what they're trying to do is reduce the amount of collectability from one period to the next, right? I don't really like this slide very much because I was expecting a journal entry here, but it's really not what's going on. So the point is, and we'll get deeper, and we'll definitely show some examples of what we mean by the allowance method, where we're crediting accounts receivable for the allowance. and we're debiting bad debt expense. Now, if we're wrong, and we're probably going to be wrong a little bit, and this is the thing we should know, and it's something that those of us who've been in business school faculty for a very long time, is the idea that we have to recognize that sometimes managers make mistakes, and they have to recognize that they're over or underestimating certain things, and and we shouldn't have an ego about this because of the fact that there are going to be errors and whatnot. Hopefully, the errors are not too large and they're not too severe to impact future ops, but you get the idea. So in this case, bad debt expense is not recognized when accounts are written off, because that would be the example of the direct write-off method. But it's recognized earlier when accounts are estimated. So this goes back to something that we've talked a bit about before, the issue of the matching principle, where we're trying to match up revenue against the losses from those revenue. So a loss would be, I sell you a good, you never pay for it. Well, that's a loss, right? It's a loss to me. But I don't want to recognize it in future periods, because I've got other activities going on that period. And why would I recognize a loss in a future period that belonged to a prior period, right? So I want to sort of estimate that. Now, it doesn't mean I'm going to be perfect with my estimate of what the losses are going to be in that current period, but I do want to sort of do my best estimate as to the recognition of that particular loss that I expect to incur, because I don't expect all my sales to be collected. And I know this is something that for those of us who lend money to individuals and whatnot, sometimes we get it back, sometimes we don't. This is business, and by the way, it's not always. I should mention this as well. It's not always the case that the business itself is being, they're trying to rip off the selling company and whatnot. It could be a case where the company's gone into bankruptcy. That's very often the case. In bankruptcy, everything sort of freezes, and all the creditors, which in this case, the receivable holder would be a creditor, are sort of frozen in place, and they sort of line up depending upon whether they're secured or whether they're unsecured. And by secured, I mean whether there's collateral involved. I can tell you that selling goods from one customer to another usually does not involve collateral. And so as a result, you're sort of lining up behind the secured creditors. And I'm not a lawyer, but I've been involved in lots of bankruptcy issues. As a lender, I can tell you that sometimes if you're a seller and you're in that position, you're probably going to get wiped out. You just probably are. So that's just kind of the way it is. But you have to estimate that. And you have to estimate it based upon the sales, the year in which you make the sales. So you are fully recognizing and communicating to the external users what's going on. So in this case, bad debt expense is not recognized when accounts are written up, because, and we'll get to the journal entries here as to how we write these off, but instead it's done ahead of time when they're estimated, and usually it's some adjusting entry at some end of accounting period, often a year, but it could be quarterly, whatever the case might be. And then when we deemed the account actually uncollectible, and I like the red letters, actually, both the allowance and the specific receivable are reduced to a write-off. In other words, the allowance, which is debited, and the bad debt expense is credited, meaning the whole thing goes away. It's done. Okay, it's done. This account is over. We've already recognized the bad debt expense. We never expected to collect it because we've already written it off. But it's not specific to an account necessarily when we do the overall allowance and the bad debt expense. But it will be specific once we write off these accounts, and we're gonna sort of debit those to the allowance account and credit those to the receivable itself. And so as a result, we're going to sort of wipe that account. So it's going to be gone. Now, it doesn't mean that account may not revive itself, and so I think we have some examples where we do that, but that's essentially what's happening. So Hawthorne Manufacturing started operations in 2021, had sales of 1.2 million, had collections of 895, leaving a balance of 305 in account receivable. So this is an example here, a very typical example. We have sales that exceed the account receivable because, exceed collections because you've got some money out the door in receivables. This is not an unusual business problem. We have sales that exceed accounts receivable because of the fact that money's out the door in terms of credit. If you're selling on credit, you are providing credit to buyers, and as a result, you are effectively financing those buyers' operations. which is why a lot of times companies need short-term financing in order to make their own payables in the very short term until those short-term receivables are collected. Remember, short payables and receivables in the short term are that short term, but when there's a mismatch in the timing there, sometimes outside financing is needed. And it could be even internal financing where some of the owners inject cash in the business. Doesn't matter. Money's money. And so as a result, you get this idea where we have to inject money in order to meet these timing issues. So auto manufacturers started, so they have collections in 3 or 5 in accounts receivable. Let's kind of walk through the scenario here because this is really an interesting example of what may happen with how we recognize this. So they indicate that they expect of the 305,000, they expect to only collect 280,000 of its receivables, so establish an allowance for uncollectible accounts of 25,000. Okay, so remember, 305,000 was on credit that was still outstanding as at the end of this accounting period, and we don't know how many accounts there were. It doesn't really matter and whatnot. We don't know what the facts are. We just know that the company's saying, okay, there's going to be 25,000 that's not going to be collectible. So what do? We debit bad debt expense and we offset that with a credit allowance for doubtful accounts. That is a contra asset, right? A contra asset to the accounts receivable account. So that balances that out. But what have we done? Remember, this is all in the balance sheet, but we're also creating bad debt expense, which is an income statement item. So we're talking a great game about this is all about the balance sheet, but there are definitely implications for the income statement here. So we're going to debit bad debt expense for that. Okay. Now we don't know what's going on down the road, but that's the estimate. And where are these estimates coming from? Well, hopefully people were informed about these matters and whatnot. And these are pretty small dollar figures, I recognize. And when we talk about public companies, we're talking about usually a lot of zeros added on to those. But let's not get worried about the amount of numbers here. Let's just kind of worry about what we're doing here. So, all right. So, whoa, went too far. Shoot. Okay, so we make that adjusting entry, right? So, all right, so Green Valley Steel, so another example, Green Valley Steel had sales of $1 million and collections of $760, leaving a balance of $240 accounts receivable as of the year end, which we're assuming 12/31 is the year end for this company. Analysis indicates it expects to collect $200,000 of its accounts receivable. How would it collect, or how would it set up an allowance for uncollectible accounts? All right, so, well, they expect to collect $200,000 of the 40,000. So what will we do here? Well, the answer is create a bad debt expense for 40,000 and allowance for uncollectible accounts of 40,000. Now, by the way, they may collect every dollar of this. They may collect every dollar. In which case, as they go forward, they're going to sort of adjust their expectations. Maybe unless this is a one-off, but they may collect every single dollar of this. But they're going to recognize this as an expense in the year in which it happens, right? And now, obviously, in public company reporting, a lot of companies do not want to overestimate bad debt expense because it reduces net income, and nobody wants that, right? However, if you're really burning hot and you're earning net income that's blowing the doors off and you're way above expectations, you may dump a lot of money into bad debt expense. I certainly saw that happen where I worked for a couple of public companies where we dumped a lot of expense in that period to sort of bring it down because we could always recover it. Maybe we do recover it on the back end, right? So the last one. So Hawthorne concludes. This issue of on April 24th, 2022, Hawthorne concludes it will not collect a $15,000 account receivable. All right, so we're using the allowance method here. So what we've not talked about is what are the entries to the accounts, the debit credit entries to the accounts once they're specifically, I'm talking about individual buyers' accounts are being written off. So let's talk about what we do here. So in this case, we have a specific write-off of $15,000. So we're going to credit accounts receivable because remember, we haven't lowered accounts receivable. We just created a contra asset that is an allowance account, right? But we're going to now credit that receivable because that receivable is done. And so we're going to credit that and we're going to wipe that. By the way, those are the same figures here. This is not a particularly good slide because it's really the same thing, but we're gonna take that out of that account. So, and let's go to a more specific example here. Sometimes, and by the way, what are we doing here? We're simply writing off to the account that doesn't exist anymore, right? So we're not going to create any new bad debt expense. The bad debt expense has already been created. Instead, we're going to run off the account itself, taking it down, and that simply reduces the amount of receivables available, right? Well, we've already sort of done that with the contra account, so we're going to sort of reduce that, and we're going to charge the allowance account for that. Okay. All right, so I'm going to zoom in on the Zoom call right now, and ask questions, but I don't have the Zoom in there. So let's talk about the allowance method and talk about accounts which are reinstated. Now, this happens. I know it sounds like a complete fantasy where somebody, a buyer does not pay a debt and whatever, but sometimes it does happen. And I've actually seen it happen in my own existence where, firms say, hey, look, the owner we had a heart attack, was out of commission, and heart surgery or whatever. I mean, oftentimes health issues or whatever, and they're back, they're running a business, and they want to reestablish relationships with sellers. This is important because remember, these are credit transactions between a buyer and seller. And so sometimes it's like, look, I'm back and I will pay you for all the amounts that we owe you. And sellers are also going to collect because this is already long ago, maybe long ago been written off. And so it's like, okay, it's a recovery, right? And recoveries are always good because you don't have to do anything for it if you're a seller, right? So in this case, the receivable has been written off. It's now reinstated. So you gotta put the receivable back on, right? So it's $1,200 in this case. You're gonna repost to the debit account, accounts receivable, and the collectible accounts. In this case, what are you doing? You're so reinstating it. So as a result, you're gonna collect that receivable, and so as a result, you're gonna go from there. But here's the thing: you've already created a bad debt expense, right? All this is past information. Do you want to restate the financial statements? Usually, no. And as a result, you're simply going to collect that transaction. You're going to restate the receivable. You're going to collect it. You're going to collect the cash. You're going to reverse the receivable itself, which you put it back on, and so it's done. So then the previous slide did not do a particularly good job in illustrating the journal transactions, but you get the idea. You have to reinstate it and then post it, and then make that account go away because once somebody's paid, there's a zero balance, right? So that's what's going on. Okay. All right. So let's talk about estimating allowance for uncollectible accounts. There are two different approaches here. The first of these is probably not it's not probably, it's not the desired approach, where we based on the appropriate carrying value, or we just simply say, okay, of the total amount of accounts receivable, whatever the number is, we're going to sort of, I don't know, create a percentage that says X% are not going to be collected. Okay. All right. So that's one approach. A better approach, which is one FASB has been pushing, has been mandating, is the idea of what we call current expected credit loss model, where we look at individual accounts and say, what is it's going on and how collectible are these accounts? This is a case-by-case study of individual buyers, and FASB is requiring it here for the last few years. And so as a result, we're going to debit bad debt expense and credit allowance based upon what we reasonably expect to be uncollectible from particular customers, using, frankly, subjective methods and based upon individual firms' experiences. But keep in mind that if you make a lot of mistakes in this area, the financial community doesn't really like that. And so as a result, maybe companies are a little bit sandbagging on some of these bad debt expenses, but if it's a bad debt, it's going to be a bad debt. At some point, it's going to hit the wall, and it's not going to be collected. So that's just kind of the way it is. And again, bad debts are oftentimes the issue of companies that one is selling to going into bankruptcy, and all the creditors, which is a seller in this case, sort of falling the line. It may be collecting, it may be not collecting. But it could be due to other issues. It could be just simply unwillingness to pay, but it's oftentimes something that's really awry that's going on, particularly in very large businesses where there's something that's really sort of messed up there. Okay. All right. So let's talk about what's going on here. So in this case, let's go on to an aging schedule. So what are aging schedule all about? So these are frequently required, particularly from the lenders, for small, mid-sized businesses where receivables are sort of laid out one by one on the left side of the page, and there's a schedule that goes left to right that says current 0 to 60 or 0 to 30, whatever the case might be, 61 to 90, whatever. And what happens is there's a percentage applied to a collectability. So if you take the 0 to 60 days, 220,000. We estimate that 5% will not be collectible. Okay. And I don't know where this number comes from. It's just sort of an estimate here. But one thing is clear is that as these things get older, 61 to 90, 91, these percentages go up. It is a reality that the older something gets, and the older an obligation gets, the less likely party is to pay. And so as a result, these percentages go up. And so as a result, we have an estimated allowance of 25,000 against a total receivables of 305,000, right? Based upon this aging schedule. And I know when I was in banking, we always required aging schedules of accounts receivable. And we were always sort of trying to guide people on how to do it and whatnot. And but we were always very concerned, particularly in short-term financing, where we didn't really know what was going on with their own customers. And were they trying to borrow to cover losses and whatnot? So, and that's really what's going on here is, remember, users are the entire customer here when it comes to financial accounting. So the aging schedule sort of lays out for everyone involved, external users, lenders being one, investors and whatnot, as to what's going on. So the aging schedule, it's usually produced fairly routinely, like on a monthly basis, actually, right? Where we know what's going on. And the percentages are estimates, and these are all nice round numbers and whatnot. And who knows what those percentages are? It really is very subjective in terms of what the receivable holder estimates. But if they're unrealistic, then that may not be what the financial community wants to see it. So as a result, that's kind of difficult. Okay, so that's the schedule, aging schedule. We usually call it aging and listing receivables and whatnot. And these are trade receivables. These are customers of the company at hand who want his sold goods too. So, all right, so let's do some more examples here. At the end of 2022, Hawthorne has a gross accounts receivable of 400,000, believes only collect 360. So what are we going to do? We're going to mark down, we're going to make an adjustment here, right? So as a result, they've already got a balance, and this is where we need to sort of understand that these are cumulative figures. These are balance sheet figures, okay? These are balance sheet figures. Remember, that's really the theme of this particular chapter. We've already got a balance in an account of 11,200, right? And that may be good news because we thought up to the end of the year, we would have charged off an additional 11,200 as we began 2022. Turns out we didn't. But as we go on to the next year, we're going to take the sales that we earned this year and say that of them, 440,000 are not going to be collectible. So we need to do an adjusting entry. And the adjusting entry is 28.8, which balances out the 11.2 to get to the 40,000. So in the adjusting entry, it's simply this: an additional debit to bad debt and a credit to allowance for uncollectible accounts. And that's an adjusting entry. And that's, in this case, it's kind of good news. Not good news that we have uncollectible accounts, but good news that we being the firm here, Hawthorne, had lower losses throughout the year than what we expected. So we have a lower amount of bad debt expense and consequent allowance for uncollectible accounts. And these are the things that we do all the time. Is the idea that we sort of tweak these amounts based on our experience. And I know a lot of companies will be very conservative in terms of charging off bad debts earlier on. You got to be a little bit careful of that for tax purposes. But in the end, maybe their experience is better because they don't collect, or they don't fail to collect some of the outstanding balances. And so as a result, they have a happy experience when it comes to time to adjusting entries at year end. But in this case, this is a good experience, right? Because if you assume that the company's going to have bad debts at all, and I think most companies are going to have bad debts. One of the few exceptions that I think we've seen over time is selling to governments, particularly the federal government, which is not to say the federal government will always pay its invoices sometimes they'll object to things and want to return things and whatnot, but they tend to pay. It's not really a credit issue, it may be more a quality issue. They'll tend to pay. They are not exactly fast, however, and that's sort of the reality of dealing with the government. And so, but there are companies that deal with that only sell to the federal government, where bad debt is not really an issue. It's more an issue of timing and whatnot. And the federal government is notoriously slow in paying invoices in some cases, but not always. Okay. All right. So that's the aging schedule that deals with how we treat this from an accounting perspective. Let's go on here and talk about some more issues here because we only got about 15 minutes, so we've got some time here. So let's go on to talk about some more things regarding receivables. And so the aging schedule itself. So this is the if Hawthorne had written off so many accounts receivable during 22, that adjustment of pre-adjustment balance, it was a debit of 2,000. All right, let's talk about this. So this is the opposite case of what we just talked about, where we did not have enough to balance out the actual bad debts, right? Remember, we're charting out bad debts. They've already written off. We're lowering receivables, right? And we're reducing the allowance account. So debit to allowance, credit to receivables, right? That's the transaction balances. But what if our prior estimation was insufficient to handle that particular remedy in this particular case, right? So we're $2,000 over, and so as a result, what do we have to do? We have to sort of make an adjustment here, right? So in this case, they have a debit of $2,000, and we had bad debt expense of $42,000, and so the ending balance is going to be 40. So instead, the adjustment balance in the allowance was, oops, oh, I went too far here, of 11.2, right? And the receivables are, wait a minute, well, they're going too far here. So in other words, sometimes you go a little bit too far, right? In both directions. By the way, this is good news and bad news both in this regard. Whatever the case might be, whether or not you've charged off too much or too little, you have to do an adjusting entry, right? And that's really what's going on here. So in this case, you've got $2,000 that was, sort of overestimated. We'll make the adjustment for that. But also, if we have if the allowance account was not sufficient, then we have to do an adjustment for that, and we can handle that. So, all right. So, and all we're really doing here is simply saying, okay, and this is probably not the best illustration that I've seen over my time teaching, but the idea is if you have an error, and the error is not uncommon, it's not anything to worry about. It's just an estimate that didn't turn out to pan out. We have to make an adjustment, and we'll make an adjustment going forward. And by the way, it's not just an adjustment for the current period, it's also it informs what's going on as we go forward. Okay. All right, so let's talk about the income statement approach, which is, again, income statements and balance sheet are sort of inextricably tied together. So if we have bad debt expense as a percentage of net credit sales, right, then what do we have here? So Hawthorne had sales of $1.2 million in 2021, estimated 2% of those sales were uncollectible. It would simply report at the end of the accounting period, $24,000 bad debt expense, and in the allowance, which is a contra asset of $24,000. Okay, so that's the adjusting entry as we approach this, right? Okay, and we don't know what the collection schedule is. I don't like this example too much because it assumes that we're not collecting anything during 2021. So I think we have to kind of live with the ambiguity here. But nonetheless, let's go on and talk about what's going on here. So Hawthorne could estimate bad debts on a quarterly basis in the income statement approach, and that is 24,000. Let's go back here to what it was here. So 24,000, and they put it under the average collectible accounts, and they only wrote off $1,000, right? Okay. Remember, when you write out these accounts using the allowance method, you're not recording them to you're recording them to bad debt expense and allowance for uncollectible accounts, right? Not the receivables themselves. So in this case, Berkeley Associates uses the balance sheet approach to estimate bad debts. It started 2021 with a credit balance of $10,000. In its allowance, they wrote off $200,000 bad debts during 2021. And its aging of accounts receivable indicates it should have a credit balance of 5,000. So no other journal entries have been made. So what does the journal entry do for bad debts? Well, there's a lot going on here. So let's kind of talk about this because we're almost out of time in this particular class session. And so what are we talking about here? So they already had a credit balance of 10,000 in its allowance for uncollectible accounts, right? Okay, so that's a contra asset, right? And they wrote off 200,000 in bad debts during 2021, right? And its aging as of the end of the year of 2021 indicates it should have a balance of 5,000 for uncollectible accounts. So what is the answer to this? Well, we got to look at it this way, right? So we had 10,000 beginning balance, right? And they wrote off 200,000, and the bad debt expense was 195. So we have an ending balance of 5,000, and the journal entry is 195, which is this bad debt expense. That brings the ending balance to 5,000. Okay, so that's what's going on there. You have to sort of piece through these transactions to kind of figure out what's going on here. And so we end up with 5,000 in the account, which may not be high or low. I don't know. It may be worthwhile, but that's the adjusting entry in order to make that transaction happen and work right. Okay. All right. So, and again, this particular set of slides, this is in your text. You can look through it for yourself, but it talks about recognition, valuation, subsequent valuation, and whatnot. I'm not going to spend time going over those. I do want to talk a bit about this idea of current expected credit loss and the model which we're using here. So I do want to talk about that. Let's talk about this idea of the credit for uncollectible, the current expected credit loss model. This is really what GAAP requires and has been, or I'm sorry, what FASB has required for GAAP accounting since 2020. And this idea of using the allowance method, we talked about the idea that the direct write-off method is not appropriate here, but it differs from the GAAP in two different ways. The probable method is removed, and probable is sort of a bit amorphous anyway. And we're going to focus on events that have already occurred. Prior practices focus on events that occurred, but we're really looking forward here as to what is reasonable and supportable forecast about the future. And that is the idea. It's one thing to look at the past experience, but it's another to look forward. So, and this may seem obvious, and I think I've sort of mentioned this before, but I think it involves a combination of both past experience and as to what uncollectible accounts are going to be, but also what future collectibility is going to be based upon all kinds of conditions. And the conditions are all over the place. There are all kinds of variables that are involved here. And so I think that's really what we need to sort of focus on here is the idea that there are going to be differences in how we account for those. And so when we talk about notes receivable, this is really where we're sort of moving into the final stage of this particular segment. And notes receivable are a little bit different. And that's the idea. We have creditor-lender arrangements, and we have a formal arrangement. So what makes notes receivable a bit different than accounts receivable? And I'm going to sort of focus on this a bit more as I get into subsequent videos, hopefully in the next couple of days, time permitting. But what's different about accounts receivable, as I think I mentioned this at the outset, is they tend to be a little bit more informal, more routine, particularly once a customer and a seller have got a relationship going on, and they sort of know what the terms are. It doesn't really have to be that formal, but notes receivable tend to be for a larger dollar figure. They tend to be for a longer term, and they tend to be for a larger dollar figure. And they often involve interest, and that's what makes notes receivable different than accounts receivable. That is, accounts receivable we simply refer to as trade receivables. If I'm selling you goods, you have a receivable, or you have a payable. That becomes my receivable. You pay me off. But in this case, we've got a longer term obligation, and the number of combinations and instances in which this may happen could be quite broad, but there are cases in which buyers and sellers create notes between themselves for whatever reason, right? It could be even not even do with selling goods back and forth. It could be just simply an injection of capital where I'm lending you money or whatnot, and that could be the case at hand. But in most cases, we are talking about an interest amount that's going to be payable from one party and receivable to another. So when we talk about short-term notes, we're talking about the idea of principal plus interest. And again, the thing we should know is principal times rate times time is the amount of interest expense. Always, it's always expressed in annual terms. All interest rates in finance are based on annual terms. So principal times rate times time is the amount, even if it's a fraction of a year. So if it's 9 months, it'd be 0.75, right? Or 3/4, whatever you might call it, right? So principal dollar figure, rate, a percentage, and time being a number. So remember, there are only really three ways to express dollar figures, express values in accounting. It's dollars, numbers, and percentages. In this case, we have all these going on here: face amount, dollar figure, annual rate, percentage, and whatever the period is, 1 year, 2 year, whatever, or 3/4 of the year is a number. And so as a result, we involve all those. And so those are all at play here in determining what's going on. So that'll be a short-term note, but we also do long-term notes. So I want to stop here. I'm going to pick this up as we go forward because we have to sort of clear this facility. But we'll talk about how we do the accounting for these notes. Remember, we're talking about receivables here in Chapter 7. It's the idea that we're extending credit to somebody, and a note is a bit different than an account receivable because it's usually got interest, maybe a longer time period, but in almost all cases, it's sort of written and formalized, and there may be things like collateral and what happens if this and this and this happen. And so these are all a little bit more tricky, but we will cover those. So, okay. If you have any questions, feel free to get with me. I'm more than glad to help. Okay. Have a great rest of your day.